IMU305 Today, our group will present about the issues and challenges of risk management in Islamic banks. I will start with abstract. Nowadays, risk in Islamic banks is high compared to conventional banks due to the uniqueness and complexity of contracts. The use of Sharia-compliant financial services and products has caused various risks in Islamic banks. Therefore, this study will discuss the issues and challenges of risk management in Islamic banks and highlight the types of common risks in Islamic banks. Besides, the literature review in this study will give an in-depth understanding about the meaning of risk management from Islamic perspective, and also objectives of risk management.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Hidayah binti Muhammad Tarmizi. My metric number is 2019415038. To begin with, risk is an unexpected and undesirable things that mostly happen in any bank, including Islamic bank. It happens when the investor invests in a high capital in order to obtain a high return. As we already know, the higher the capital and return, the higher the risk taken.
Assalamualaikum, my name is Farah Dahlia binti Mustafa Kamal. I'm from IC1105CB. My metric number is 2019686632. Today, I will present about the definition of risk management. Risk management is defined as a systematic method of identifying, analyzing, treating, and monitoring the risks that are all involved in any activity or process. It also a systematic method that minimizes the risk, which may be an impediment to attainment of objective. Moreover, according to the Institute of Risk Management, they stated that risk management involves understanding, analyzing, and addressing risks to make sure organizations achieve their objective. As we do not know the outcome of the risk, whether the result is what we expected or vice versa, so as a precautionary step, we need to implement an effective risk management system to minimize the risk. Next, risk management from Islamic perspective. In Islam, there are two sources that explain about risk management from Islamic perspective, which is from Al-Quran and As-Sunnah. First of all, in the Al-Quran, there are many verses that explain about risk management to guide human beings so that they know how to minimize risk in their money, financial, and other matters. As an example that we can see is from Surah Yusuf, verse 47 until 49. Based on that verse, Prophet Yusuf had interpreted the dream of the king of Egypt. Prophet Yusuf said that Egypt would experience 7 years of prosperity followed by 7 years of drought. Therefore, to face the risk of the 7 years of drought, Prophet Yusuf advised the king of Egypt to do an economic strategy where the Egyptians had to actively plant crops in the 7 prosperous years so that the result could be used in the 7 years of the drought as well. With this management, the country is safe in the face of a long drought. Next, the other risk management from Islamic perspective is from prophetic traditions. There is one hadith that talk about risk management, which is hadith on tying a camel. The hadith was narrated by Anas bin Malik. Arab Bedouin asked the Prophet Muhammad, "O the Messenger of Allah, should I leave my camel untied and trust in Allah, or should I tie it?" The Prophet replied, "Tie your camel and then trust in Allah." Based on the hadith, it explained that a person must be good at managing the risks that will be faced. He or she cannot simply tawakkal to Allah without striving to reduce risks.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Nazura Abdi Jamari from the Station 110 Next, we will look at objectives of risk management. According to Calendro, there are two objectives, which are reducing egregious threats for expanding before they appear, and to assist leaders track and recognize their weak signals. Next, according to Revino and Vitola, for recognizing the particular characteristic from particular risk generated by the organization. And lastly, according to scientist ETL, to help produce a strategic resolution that donates to the accomplishment of an organization's entire corporate goals.
Next is methodology. Methodology means techniques, methods, and approaches used to achieve the objectives of the study. This study is used a qualitative method. Therefore, this method will use secondary data to get the ideas regarding the topic of the study. This approach is used by surveying scholarly articles, journals, past theses, books, and other sources that are related to the study. The first types of common risk in Islamic banks is credit risk. Credit risk is defined as the failure of receivables to return the loan. Credit risk also covers the delay in repaying the loan, which can cause problems in cash flow and affect the liquidity of the bank. Credit risk occurs in mudharabah investments, murabahah transactions, as well as the contracts of Bait Salam and Istisna. In mudharabah investments, Islamic banks as a Rab al-Mal are exposed to high credit risk. They are unable to know and determine how the activities of mudarib may be monitored if claims of losses are made, because the nature of mudharabah contracts does not give the bank the right to participate in the management of a project. Another definition stated by the State Bank of Pakistan regarding the credit risk in mudharabah contracts is the risk inherent is transformed from market risk to credit risk during the contract life. For example, if the mudarib is shown to be negligent or dishonest, the invested capital in the mudharabah contracts will be converted to debt. In murabahah transactions, Islamic banks are exposed to credit risk when they deliver the asset to the client but do not receive any payment on time. Due to the non-binding nature of murabahah contracts, the client has the right to decline delivery of the product purchased and resulting in the bank being exposed to market risk. Lastly, Islamic banks are exposed to credit risk under the contract of Bait Salam and Istisna if they fail to supply products on time or fail to fulfill the quality of products as stipulated in the contract. Then, Islamic banks may be exposed to financial and capital losses as a result of such failures. That's all from me.
5.2 is about market risk. Market risk is the efficient or unavoidable risk. It's associated with market aspects that influence all companies and cannot be disposed of by diversification. There are 5 main drivers of market risk. First is equity prices, which means one may sell or buy a share of common stock with the amount of money. Second, commodity prices are reduced sums of the rational desire of future payoffs related to holding the commodity. Third, interest rate, a percentage of the principal, which is the amount loaned and the amount of a lender charges a borrower. Fourth, credit spreads is comprised the sale of a second similar option with a different strike price and the purchase of one option. And lastly, foreign exchange, or known as forex, which means the exchange of one currency for another.
Assalamualaikum warahmatullahi wabarakatuh. My name is Pradifa binti Rasul. My matrix number 2019236446 and I'm from IC1105CA. I will present about liquidity risk of Islamic banks. Liquidity refers to the ease with an item can be exchanged swiftly without sacrificing too much value. According to the Islamic Financial Services Board 2012, liquidity risk is the danger of not being able to satisfy bank obligations or fund asset increases when they are due without incurring unacceptable costs or losses. Islamic banking activities differs from those of conventional bank in both substance and form, and as a result, they have a different risk profile.
The next is operational risk. Operational risk means as the risk of a change in value caused by the fact that actual loss incurred for inadequate or failed internal process, people and systems, or from external events differ from the expected loss. Operational risk can be divided into 5 categories, which the first one is nature of risk, that have 2 types, which is internal and external. Internal is when the employees of the company intends to cheat, abuse the law and the property intentionally, while the external is something that happened out of the Islamic bank control, like fraud and hacking. Next is impact of risk, which have direct and indirect. Direct can cause loss to the company and indirect can improve the operational risk. Then degree of expectancy. It can be defined as an expectation to identify and face operational risk. There are expected loss where it happens consistently, and unexpected loss is something that cannot be identified. After that, frequency of magnitude of loss is the loss that is suffered by operational risk, and the last one is hazards, events, and consequences. It happens due to the weakness in internal controls and comply with the procedure that is contrary to Sharia.
Now I will talk about one of the issues and challenges of risk management in Islamic bank, which is credit risk management. Firstly, in the case of Mudharabah, credit risk management will appear when Rabbul Mal, which is the bank, has to provide capital in advance to the Mudharib, which is the entrepreneur, to do a business without knowing whether the business will make a profit or a loss. For example, the bank has agreed to enter into a Mudharabah contract with Ali. The bank gave Ali a capital of 50,000 ringgit to do business and share the profit that will be earned. Meanwhile, if the business incurs a loss, the bank will have to bear it. Hence, we can see that the bank has to bear credit risk because the bank has given money to Ali to do business, but the business that Ali is doing does not know whether the result is profit or loss. Secondly, in the case of Murabaha transaction, credit risk can exist in two ways, which is when the bank has taken on some actual liabilities, then customer can sell his option to buy the commodity. This is a credit risk to Islamic banks because they have withdrawn money to buy the commodity, but the commodity is not sold because the customer has cancelled the purchase. Other than that, the other way that credit risk can exist in Murabaha transaction is when the Islamic bank has given the commodity to the customer but has not received payment from the customer in a timely manner. This indicates that there is a credit risk when the payment of the commodity by the customer is not made within the stipulated time. Lastly, credit risk in salam contract. Credit risk exists in this type of contract when the commodity is not delivered on time. For instance, Islamic bank have paid the price of the commodity by entering into a contract of salam. So the goods will be given to the Islamic bank on the next date that has been set during the contract. To clarify, the bank has to bear the credit risk because the commodity has been paid for, but there is a possibility of default on the commodity's delivery.
About market risk management. In Bangladesh, Islamic finance sector have posed challenges because of long-standing constraints. This is because a need of Islamic investment products and liquidity management products also restricted motivation from regulators for sukuk issuance. However, Bangladesh officials have offered several conventional banks to convert into Islamic banks. In Bangladesh field, Islamic banks account for around 38% of remittance handling, 28% of loans and advances, and 27% of deposits.
Islamic risk management. When the financial crisis hit, Islamic banking became increasingly visible by being the only bank that didn't request for liquidity. Liquidity hedges are more critical than the operational risk and risk rate of return to keep Islamic banking afloat. There are several factors that could lead to liquidity risk in Islamic banks, including a lack of money market instruments between Islamic banks, a lack of Islamic financial instruments in the secondary market, and the widely available in the secondary market is conventional financial based on interest, which could result in a ban of the Islamic financial system. The fixed effect model is the best model in Islamic banking, while the model of random effect is the best model in conventional banking.
Next is operational risk management. It also faces some issues and challenges like fiduciary risk, Sharia non-compliant risk, legal risk, and reputational risk. The first one is fiduciary risk, which a failure in fiduciary responsibility, such as in performing something according to standards, that can be seen through the level of decline and increase in their income, which can lead to the company bankruptcy. The second is Sharia non-compliant risk, which when an organization fails to comply with the principles set by the Sharia part of the Islamic Financial Service Board. Then, legal risk, it arising from operation in Islamic bank and the uncertainty of identifying Sharia law problems. For instance, fraud occurring where it causes loss and raise issues in the legislation. Lastly is reputational risk. It happens when there is negative perception of the bank from the customers. As examples, the customers spread some bad rumors about the company due to the dissatisfaction through mass media or directly with the bank.
Banking. In conclusion, a well-developed risk management system that can detect any potential deterioration in the asset quality of the Islamic banking portfolio is a short-term requirement. This is necessary in order for Islamic banks to maintain enough provisioning in dynamic scenarios, anticipate future earnings, and use Sharia-compliant risk mitigation measures to minimize volatility and remain competitive. That is all from us. Thank you.